The Four Pillars of Investing. Lessons for Building a Winning Portfolio by William J. Bernstein. Introduction. In 1998, the world of high finance watched in awe as a hedge fund called Long-Term Capital Management, or LTCM, imploded in spectacular fashion. This wasn't just any fund. It was run by Wall Street's best and brightest, including two Nobel Prize-winning economists who had literally written the book on financial theory. They had developed impossibly complex trading strategies, leveraged their bets with enormous amounts of borrowed money, and for a short while, they looked like geniuses, quadrupling their investors' money. And then, in the blink of an eye, they were wiped out. Their complex models, built on historical data, failed to predict a simple truth: sometimes, the world goes a little mad. Now, let me tell you another story. It's about a woman named Sylvia Bloom. Sylvia was not a Nobel laureate. She was a legal secretary at a New York law firm, where she worked for an incredible 67 years, from 1947 until 2014. She lived a quiet, unassuming life. She dressed well, but not extravagantly. She took the bus and the subway. When she passed away just shy of her 99th birthday, her niece, who was handling her estate, was stunned by what she found. Sylvia Bloom had amassed a fortune of over $9 million. No one knew. Not her friends, not her co-workers, not even her husband. This quiet secretary had succeeded where the titans of finance had failed. How? What did this woman, with no advanced degrees in economics, understand that the geniuses at LTCM missed? The answer to that question is the key to a lifetime of successful investing. And it's the journey we're going on today, guided by one of the wisest minds in modern finance, William J. Bernstein. In his classic book, The Four Pillars of Investing, which has sold over 75,000 copies, Bernstein, a former neurologist, applies a scientist's clarity to the often chaotic world of money. He reveals that building lasting wealth doesn't require genius or complex formulas. It rests on four simple, timeless pillars. Today, I'm going to share those four pillars with you. By the end of our time together, you will understand the profound, simple secrets that allowed Sylvia Bloom to build a fortune, and you will have a blueprint to begin building your own, no matter where you're starting from. This isn't about getting rich quick, it's about getting rich for sure. Book summary. Imagine your financial life is a long road trip. You, your present self, are the driver, and your destination is your future self, the person you hope to be, living a comfortable and secure life. William Bernstein calls this journey the highway of riches. It's a beautiful road, but it's also filled with potholes, black ice, and treacherous mountain passes with no guardrails. The Nobel Prize winners at LTCM tried to race down this highway at 200 miles an hour. They put the pedal to the metal, using borrowed money to make their bets even bigger. And for a little while, the ride was thrilling. But at that speed, the slightest bump in the road sent them flying into a ditch. They risked everything they had, for money they didn't even need. Sylvia Bloom, on the other hand, drove slowly and steadily. She understood that the most important thing on this journey is to arrive at your destination safely. She didn't use borrowed money. She was frugal, but not cheap, saving consistently over decades. And most importantly, she had time on her side. She let the quiet magic of compound interest work for her, year after year, decade after decade. Her strategy survived. LTCM's did not. And that, right there, is the first and most important lesson. Investing is not about finding the optimal, perfect strategy that promises the highest returns. It's about finding a solid, dependable strategy that you can stick with, a strategy that survives fear and panic. To build that kind of strategy, Bernstein tells us we need to understand four crucial things. These are the four pillars. The first, and most fundamental pillar, is the theory of investing. If you learn nothing else today, learn this: risk and return are joined at the hip. You cannot have one without the other. Anyone who promises you high returns with no risk is either a fool or a liar. Bernstein uses a wonderful thought experiment to explain this. Imagine your employer, Uncle Fred, offers you a retirement plan. Every year, he'll contribute $5,000. You have two choices for how to invest it. Option 1 is safe. You get a guaranteed 3% return, no matter what. Option 2 is risky. You flip a coin. Heads, you make a 30% return for the year. Tails, you lose 10%. That second option sounds terrifying, doesn't it? A 50-50 chance of losing 10% of your nest egg every single year. The safe 3% feels so much more comfortable. But let's look closer. Over time, you'd expect to get about half heads and half tails. When you do the math, that coin flip averages out to a return of over 8% per year. That extra 5% you get from the coin flip, compared to the safe option, that is what financiers call the risk premium. It's the reward you get for being willing to endure the anxiety of the coin flip, for taking on the risk of loss. This is the essence of the stock market. Stocks are the coin flip. They offer higher returns over the long run because they come with the terrifying, gut-wrenching possibility of short-term losses. Those losses, as Bernstein says, are the ticket price for the theater of stock market returns. If you're not willing to pay the price of admission, the occasional, bone-crushing drop, you don't get to see the show. Bonds and cash, on the other hand, are the safe option. They won't give you heart palpitations, but they also won't make you wealthy over time. This leads to a simple formula for estimating what you can expect from the stock market over the long term, called the Gordon equation. It says that your expected return is simply the dividend yield plus the rate at which those dividends grow over time. That's it. That's the fundamental return, what the underlying businesses are actually producing. Anything else, any short-term jump or crash in price, is what Bernstein calls speculative return. It's just noise. In the short run, that noise is deafening. But over a lifetime, it's the quiet, steady hum of the fundamental return that builds real wealth. So, the theory is clear: to get higher returns, you must accept higher risk. But knowing this in theory is one thing. Living through it is another entirely. Which brings us to the second pillar, the history of investing. An engineer who doesn't know the history of bridge building can still build a perfectly good bridge, because the laws of physics don't change. But an investor who doesn't know financial history is, as Bernstein puts it, irretrievably handicapped. That's because finance isn't a hard science. It's a social science, driven by the unpredictable emotions of human beings. The market, as the legendary investor Benjamin Graham called it, suffers from a severe bipolar disorder, swinging wildly between euphoria and depression. History is our library of market psychology. It shows us what happens when the collective mood goes off the rails. These periods of madness are called bubbles, or manias. And they all follow a predictable pattern. Bernstein takes us on a tour of some of the most famous bubbles in history. There was the South Sea Bubble in England in 1720, where shares in a company with a supposed monopoly on trade with South America soared to astronomical heights before collapsing and ruining thousands, including the great scientist Sir Isaac Newton, who famously lamented that he could calculate the motions of the heavenly bodies, but not the madness of the people. Then came the British railway mania of the 1840s. Railroads were the disruptive technology of their day. The internet and AI rolled into one. The public's excitement was so intense that companies were formed to build railways from literally nowhere to nowhere, with no towns along the way. Everyone was convinced they were getting in on the ground floor of a new era. Then, just like before, the bubble burst, and families were ruined. And of course, there was the roaring 20s in America, fueled by new technologies like the automobile and the radio, and by easy credit. Stock prices reached what one famous economist called a permanently high plateau, just days before the crash of 1929. What do all these stories have in common? Bernstein identifies 4 key ingredients for a bubble. First, easy money and low interest rates, which make people eager to find higher returns. Second, a new, exciting technology or financial innovation, a compelling story that captures the public's imagination. Third, a generation of new investors who have no memory of the last crash, who tell their skeptical elders, "You just don't get it." And fourth, the abandonment of old, boring valuation methods. People stop asking, "What is this company's dividend yield?" and start saying, "This time is different." When you see these 4 signs, you know you're in a bubble. But history doesn't just teach us about the manic highs, it also teaches us about the depressing lows, the crashes and bear markets that follow. These are the times of maximum pessimism, as the great investor John Templeton said. They are the times when newspapers run headlines like "The Death of Equities," as Businessweek did in 1979, right before one of the greatest bull markets in history. These are the moments when fortunes are made. Not by timing the market perfectly, but by having the courage to buy when everyone else is selling, when the fear is so thick you can taste it. As Benjamin Roth wrote in his diary during the depths of the Great Depression, the difficulty is that no one has the cash to buy. The people who do have the cash, the unimpaired capital, are the ones who get rich. History, then, is our guide. It shows us the patterns of human behavior that repeat, again and again. It teaches us to be skeptical when everyone is euphoric, and to be brave, or at least, not to panic, when everyone is terrified. But if these patterns are so clear, why do we keep falling for them? This leads us to the third, and perhaps most important pillar, the psychology of investing. The biggest obstacle to your financial success isn't the market, the economy, or your broker. It's the person staring back at you in the mirror. Our brains, Bernstein explains, were not designed for the modern world of investing. They were forged over hundreds of thousands of years on the African savanna, where survival depended on quick, instinctive reactions. Modern neuroscience talks about 2 systems in our brain. System 1 is our ancient, reptilian brain. It's fast, emotional, and intuitive. It's what makes you jump back from a snake. System 2 is our modern, rational brain, the neocortex. It's slow, analytical, and deliberate. It's what you use to solve a math problem. The problem is, when it comes to investing, our System 1 is almost always in charge, and it gives us terrible advice. Take our relationship with risk. System 1 is wired for what behavioral economists call myopic risk aversion. It's obsessed with short-term losses. A 10% drop in your portfolio feels like a charging lion. Your amygdala, the brain's fear center, lights up, and your instinct is to run. To sell everything. But in investing, the biggest risk isn't a short-term drop. It's the long-term risk of not having enough money for your future. Your System 1 is screaming about the snake at your feet while ignoring the slow, silent threat of starvation down the road. We also suffer from crippling overconfidence. We all think we're above average. One study found that nearly all business school students rated themselves as above-average drivers, which is mathematically impossible. We do the same with investing. We think we can pick the winning stocks or find the next superstar fund manager. But as we've seen, the evidence overwhelmingly shows that almost no one can do this consistently. We're playing tennis against an invisible opponent, and most of the time, that opponent is Serena Williams. And then there's our fatal attraction to stories. We are narrative animals. A compelling story about a revolutionary new company will always be more persuasive to our system one than a boring spreadsheet of financial data. This is why we fall for great company. Great stock fallacy. We see a glamorous company like Amazon and assume its stock must be a great investment, while ignoring a boring, profitable company that makes, say, cardboard boxes. But history shows that it's often the boring value companies that produce higher returns over time. All of these psychological traps, our fear of short-term loss, our overconfidence, and our love of stories, make us our own worst enemies. Mastering investing isn't about being smarter than the market, it's about being more disciplined than ourselves. It's about building a system that protects us from our own worst instincts. And that's a good thing, because the financial world is filled with people who are experts at exploiting those instincts. Which brings us to the fourth and final pillar, the business of investing. You need to understand that the financial services industry is not your friend. It's a business designed to do one thing: separate you from your money. It's a battlefield, and you need to treat it as such. Bernstein is ruthless in his assessment. He compares the average stockbroker to the gangster babyface Nelson, servicing his clients in the same way Nelson serviced banks. That might sound harsh, but consider the structure. For decades, brokers were paid by commission. Their income depended on how often you traded. So, their incentive was to get you to churn your account, to buy and sell as much as possible, regardless of whether it was good for you. Today, many have shifted to a fee-based model, charging a percentage of your assets. It's an improvement, but the conflict of interest remains. Their job is to gather assets and charge fees. And they often do this by selling complexity. They create portfolios with dozens of overlapping funds to make it look like they're doing something sophisticated, when a simple, low-cost portfolio of a few index funds would almost certainly perform better. Then there's the financial media, which Bernstein labels investment pornography. Their job is not to inform you, it's to entertain you and sell advertising. And what sells? Stories about superstar managers, hot stock tips, and market forecasts. The boring, sensible advice, buy a diversified portfolio of index funds and hold it for 50 years, doesn't sell magazines or boost TV ratings. So they create a constant drumbeat of noise designed to trigger your system one, to make you feel like you need to do something. But the best thing you can do, most of the time, is nothing at all. So, how do you navigate this minefield? Bernstein's advice is simple: stay away. Stay away from brokers who want to pick stocks for you. And turn off the financial news. The good news is that over the past few decades, a safe harbor has emerged: the world of low-cost index funds and ETFs. Pioneered by John Bogle at Vanguard, these funds don't try to beat the market. They simply seek to be the market, owning all the stocks in an index and passing the returns on to you, minus a tiny fee. They are the ultimate expression of humility. They are the admission that you can't beat the market, so you should join it as cheaply as possible. And this brings us full circle, back to Sylvia Bloom. Her $9 million secret wasn't a secret at all. It was the simple, elegant application of these four pillars. She understood the theory. She wasn't trying to get rich quick, but get rich slow, letting compound interest do the heavy lifting. She embodied the lessons of history. She wasn't swayed by the manias or panicked by the crashes. She just kept her money invested, decade after decade. She mastered her own psychology. She was frugal and disciplined, immune to the siren song of hot stocks and market chatter. And she sidestepped the business of investing. She didn't have a broker churning her account. Her strategy was likely as simple as buying and holding a diversified portfolio of good, solid companies. She built her financial house on a rock-solid foundation of these four pillars, and it stood the test of time. Commentary. So what do we take away from all this? After journeying through the theory, history, psychology, and business of investing, what is the single most important lesson from William Bernstein's The Four Pillars of Investing? I think it's a message of profound humility. In a world that celebrates genius, complexity, and rapid action, Bernstein reminds us that the path to wealth is paved with simplicity, patience, and discipline. The heroes of his story are not the swashbuckling hedge fund managers or the fast-talking TV gurus. The hero is Sylvia Bloom, the quiet secretary who understood that the race is won not by the swift, but by the steady. This book is a powerful antidote to the noise and anxiety that surrounds the world of money. It tells you that it's okay to not have an opinion on where the market is headed next week. It's okay to not know who the hot new fund manager is. In fact, it's better. Your ignorance of the daily noise is a superpower. The most practical action you can take away from this book today is to embrace the beauty of boring. If your investment strategy is exciting, you're probably doing it wrong. A successful strategy should be as dull as watching paint dry. So, what can you do, right now, as a 17-year-old? First, start saving. Anything. The amount doesn't matter as much as the habit. Take a small amount of money from your part-time job and put it away. Make it automatic. This is you, starting your slow, steady drive down the highway of riches. Second, open an account and buy a single, low-cost, Total World Stock Market Index Fund or ETF. Just one. Don't try to pick stocks. Don't try to time the market. Just own the whole haystack. This single action will put you ahead of 90% of all investors, professional and amateur alike. And third, and this is the hardest part, learn to ignore everything else. When your friends are talking about a hot cryptocurrency, smile and nod. When the news is screaming about a market crash, turn it off and go for a walk. Your greatest challenge will not be finding the right investment, it will be tuning out the noise and sticking to your plan. This book isn't just a guide to investing, it's a guide to thinking. It teaches you to be a skeptic, to question narratives, and most of all, to be humble in the face of uncertainty. It teaches you that in the long run, character is more important than intellect. Discipline is more powerful than genius. That was a summary of The Four Pillars of Investing by William Bernstein. We've covered the core ideas today, but a summary is like looking at a postcard of the Grand Canyon. It gives you a sense of the scale, but it can't capture the feeling of standing on the edge and looking out into that vast, beautiful emptiness. The real power of this book is in the stories, the historical details, and the quiet wisdom woven into every page. It's in the moments where you pause and think, wow, I've been thinking about this all wrong. This summary is your map, but the treasure is in the book itself. If any of these ideas have sparked something in you, I truly encourage you to pick up a copy. Reading it isn't just learning, it's an experience that will give you a sense of calm and control over your financial future that is, frankly, priceless. You can find a link to the book in the description below. Also, if you found this journey valuable, please take a moment to click that subscribe button. We explore a life-changing book from the billionaire's bookshelf every single week, and I'd be honored to have you join us as we continue to learn and grow together.